Hey everyone, Russell Gray, co-host of the Real Estate Guys radio show with the next module in our series, Everything You Always Wanted to Know About Silver But Didn't Know to Ask. We're with our good friend and precious metals expert, Dana Samuelson. Hey, Dana.
Hi, Russell. Good to see
So,
you.
yeah, we're having a good time. And the off-mic conversations are just as fun as the on-mic conversations. I'm happy to be a fly on the wall in my own studio to get a chance to participate in this. I just find this fascinating. Maybe not everybody out there thinks this is fascinating, but I think it's fascinating. And I think, we're sitting here in July of 2020, and there's a lot of pressure on the dollar, fiat currencies around the world in general, but on the dollar especially. And if you don't have a hedge against a problem with the dollar, then you're living dangerously, in my opinion, in this particular time in history. Precious metals is one of the places, arguably maybe one of the best, if not the best places to hedge. And there's a difference between gold and silver, and that's something we've been talking about. In this module, we want to talk a little bit about the cost of production. And the reason cost of production matters is because it's something that needs to be manufactured at a price, right? The Fed can print money at no cost. It has no cost to manufacture. Therefore, its intrinsic value is zero. It can go all the way down to zero because it didn't cost anything to produce. And that's one of the concerns you have is when they print them ad infinitum, right? And just print them till forever, trillions and trillions and trillions of them. The danger is that they begin to lose value. And if you want to preserve value, you've got to use them when they're still valuable and buy things that are real that will retain their value. Well, real estate is great for that, especially if it brings income and agriculture and energy. And there's all kinds of things that you can buy that are real and essential and part of the go forward human existence that are going to have a bid, a demand. They're going to be valuable. But if you want to be liquid, if you want to have a degree of portability and the ability and privacy and the ability to pivot from one currency to another, it's hard to beat things like precious metals. Maybe gems, there's some things, but metal is great because it's very easy to assess the value of it, especially when you're dealing with pure bullion. There's little machines, and Dana, maybe you can take a second and talk a little bit about how you make sure that the metal you're getting is pure, and then we'll get into cost of production.
Well, we have different ways to test metal. We actually have some industry developed items that have come about in the last 3 or 4 years that measure density. We can put a precious metals item on it and it'll measure the density of the item. There's a specific gravity, which is a little bit more complicated. It involves water and beakers, but you can literally measure, accurately density that way. And then there's just the old fashioned way where I've been in the business 40 years. I've handled more physical gold and silver have gone through my hands than almost any other person in the United States over the last 25 years in particular. Just know what it looks like, what it sounds like, what it feels like. So I look at literally everything we buy that goes into our inventory. So when it goes out, I know it's good because I buy it all back. And there's just a certain characteristics for the way things are made. If you pour 100 ounces of silver into a bar, it's molten, it goes into a bar mold, that silver is going to ring around the edges. Pure silver does that. Non-pure silver doesn't. There's a lot of little tricks we use, but we make sure that everything we get is what it's supposed to be.
Well, so here's my point. My point is that maybe unlike diamonds, where you have to depend upon a trained eye and an expert, and it's great to have an expert, and you do need to have somebody that you trust, that you do business with in this space.
Absolutely.
But unlike precious gems or even numismatic coins, which we'll talk about later, the value of metal by its bullion content and the purity of that bullion is fairly scientific. It's very objective. It isn't somebody's opinion. It's pretty much there. So you can be relatively assured. And so anyway, the point about that is that metal is a very useful tool for preservation of wealth and storing of wealth because it acts as money and portability. And so that's the reason that, we're kind of talking about this. But It does need to be produced. And so right now, what we're here to talk about is the cost of production and the components of cost. And the reason it's important is because when the cost of production exceeds the market price isn't set by cost of production.
No.
Market price is set by supply and demand. So that's called price discovery. When you have a free marketplace where people are not coerced or forced into the marketplace, they don't have to do anything other than by of their own free will, and they come together and people start bidding. The price that gets settled on when buyer and seller do business in that type of an environment is called the true price. That's price discovery. And when they settle on a price, if there's abundance, if somebody has excess and is in desperate need of cash, they might sell below cost, right? When the financial crisis hit in 2008, you could purchase houses because there was distress everywhere. People were selling below the amount they owed on it, negative equity. And so houses literally were selling for below replacement costs. Well, if you were an astute real estate investor and recognized that was a temporary situation, it was a great opportunity to go acquire lots of real estate in great markets that were poised to rebound, because at some point, all of that excess inventory that had been created during the boom got absorbed. And now when new buyers were coming to market and wanting homes, there weren't any. And builders hadn't built any because they couldn't afford to build them. And so the prices came back up. And that's what happens in a free marketplace, is the supply and demand regulates not just the price, but the supply. And so that's where cost of production factors in. And so, we're seeing that in shale oil right now. In shale oil, you've got shale oil producers that can't produce oil for less than, say, $45 or $50 a barrel, and it's floating around $30 as we're recording right now. The rig count is going down. Production is coming offline. Now, right now, we have a glut of oil because we have no economic activity, which means we have no consumption of energy. But if the economy recovers and we go back to somewhat normal levels of economic activity, then what we're going to end up seeing is the increased demand for energy and oil, but the production's offline.
Right.
And so if you recognize that and you can figure out how to play the game, you're like, hey, you know what? It might not be bad to get into an ownership position, because some day when oil goes from 30 to 60 or 80, all that $30 oil that I bought or production that I bought is going to be worth a lot more. Of course, oil is a trickier game, but precious metals, you can do the same thing.
Right. That's exactly right.
And so, Dana, talk a little bit about some of the components of production cost, and I'll have some things to say on that as well when it comes to silver, or metal in particular, but silver.
Well, first of all, you have to find deposits in the ground, which is not necessarily easy. All the low-hanging fruit over the last 50 years has been found. So they have to keep going deeper and farther into the ground to find it.
Okay, so a component of cost, like in pharmaceuticals or high tech, is R&D. Is
Right.
research. You've got to find it. There's exploration expense. A lot of searching yields nothing. That's why in oil exploration, it's extremely risky. If you hit it, you get paid big. But if the odds of hitting are very, very low. So so number one is you've got the expense of locating new finds, and most of the low-hanging fruit is gone. So that's going to tend to be going up over time, not down. Is that what you're saying?
Yes.
Okay.
Yeah.
All right. What else?
Well, it's a dirty business. You have to move a lot of dirt to get precious metals out of the ground.
Dirt's heavy.
Yeah, gold. It says takes a ton of dirt to find 1 ounce of gold, and silver, is even harder to find in quantity. So there's a lot of equipment that's involved, a lot of man hours, labor. Some of these mines go, way deep in the ground, a mile deep, some of them. It's crazy.
Okay. So you have labor expense. And so,
Right.
if you're paying attention to the labor pool, you're paying attention to the direction of wages, you're paying attention to the various costs related. If you see things like minimum wage going up or healthcare benefits costing more or things like that, then that's going to add to labor expense. And so that would tend to be bullish from a price standpoint in terms of increasing the cost to do. But there's something else you mentioned in there, Dana, I want to point out, and that is that you got to move tons of dirt, literally. And dirt is extremely heavy. Well, how do you move all that? Heavy equipment. What do those heavy equipments run on? Energy, oil.
Right.
Now go back to what we just talked about with oil. There's a relationship between oil and metal, and I think a lot of people don't understand that. Because of the intense energy demands of precious metals, you can recognize when the cost to produce is going to be lower based on a low cost of energy, and when the cost to produce is going to go up based on an increase of energy. So let's just say, hypothetically speaking, that we're in a season where oil is cheap. Oh, wait, we are. And we're in a season where, because of that low price, a lot of production is coming offline. Oh, wait, we are. And then say somewhere down the road that economic activity increases from its current point, meaning that today would be below average. Oh, wait, we are. And so then down the road, oil could spike, which would drive up the cost to produce of precious metals. Is that kind of a fair connecting of the dots?
Yes, absolutely.
And so that's one of the reasons we pay attention to it. So energy is another component of cost. Okay, so now there's going to be a little bit of a divergence between silver and gold. When people go looking for gold, they're looking for gold because gold is so expensive, it's worth looking for in its own right. And if you find something else, that's nice, but gold is like center of the target. Silver's
Right.
not like that.
No, because of the value in the marketplace, most mines don't pay if they're just simply silver mines because the time and effort and energy and expense it takes to get it out of the ground and get it refined, it doesn't financially work at under $15 an ounce for most mines or even under $20 an ounce. So it's a byproduct of mining of other metals for the most part, with gold being one of them. And then there's copper and nickel and zinc as well. So it's not a primary metal that you go looking for to just get unless you find a very high grade and easily accessible deposit, which is becoming fewer and farther between these days.
Yeah. So this goes back to this idea we talked about in the previous module about what's going on in industry. So if you're watching silver and you're paying attention to economic activity, industry, industrial demand for all types of metals, you can begin to get an idea whether or not there's being a lot of silver being discovered or not so much being discovered. And so as existing inventories, and we'll talk about that later, but as existing inventories of silver get drawn down and the production isn't there as a byproduct of industrial production because of decreased industrial metal consumption, which is exactly what's happening as we're going through this COVID-19 crisis, then the expectation is that at some point, all of these factors are kind of converging to point at a lot of upward future pressure to the production costs of silver. Does that make sense, Dana?
Yes, absolutely.
Yeah. So again, we're talking about the gold silver ratio in our previous module being near 100, which is historically pretty high. That silver is 2/3 below its $55 all-time high that it hit twice, whereas gold is flirting with its all-time high. And then you've got these other factors related to cost of production. So, in my mind, again, I'm not a speculator. I don't look at buying silver cheap so I can sell it someday high. I'm not interested in trading assets for dollars. I'm interested in trading dollars for assets. But when I do trade my dollars for assets like silver, the question is, do I want to pay a lot for it or a little? Well, I want to pay a little. And so the question is where am I at in the cycle? And I think that, for me, and I'm just speaking for myself, and Dana, I'll let you comment on this also, because you deal with a lot of professional investors and you're a professional investor yourself, especially in the metal space. I'm not, I'm just an amateur. I'm a guy that just, is fascinated by this. And I try to figure out how metals and real estate and financial strategy all fit together. But, where are we at in the cycle? Does silver make sense based on where we're at in the cycle?
Oh, absolutely. Every way you measure it, whether it is price, absolute price, price relative to gold, price relative to production, price relative to supply in the marketplace and demand, it's undervalued in every component. It looks like it should be on paper to me, silver should be 21, 22, maybe even $25 an ounce right now when it's only 18.50, but it's in a rising trend. And, I go back and I look at charts a lot. And right now, silver's tipping into the next higher trading range, which is 1850 to 2070. And above 2070, as investors say, is blue sky. There's not much price resistance over 2070 in gold if you go back 20 years. The next resistance point is 27, $28. So there's a lot of potential upside in silver, especially relative to gold and especially to the other components that we discussed. So silver looks like it's undervalued by quite a bit to me right now. And when it does play catch up, it tends to play catch up with a vengeance. So, there's an opportunity window that exists right now. When it closes, it can close kind of hard and fast. So if you're interested, don't hesitate.
Yeah. So let me answer a question I'm sure some people are thinking. It's like, okay, well, if I'm not interested in using silver to accumulate dollars, what good is it? Because I can't spend the silver. Well, you can, because when you do decide to spend it, you convert it into dollars just for a very short period of time until you transition into whatever it is you want to buy. The challenge is that in an inflationary environment where the purchasing power of dollars are falling, the things you might want to buy are also going up in price. And so relatively speaking, have you really preserved purchasing power? Yes, but have you gained purchasing power? No. The only way to gain purchasing power is to accumulate debt in an environment like this, to control assets that you want to own free and clear someday. And then instead of you paying cash for that asset today, put the cash into something like a metal that is going to preserve its purchasing power, but later on, in response to all of these various factors, some of which are going to be the supply-demand dynamic, which I think lends towards the outpacing inflation in terms of growth. Mm-hmm. When you look at the energy component and the cost of production components, that I think can give you the opportunity to outpace inflation. And then you have the inflation component, which will keep pace with inflation. And you marry all of that upward pressure in terms of dollar, and then to fixed cost with debt on the other side of your balance sheet, then somewhere down the road, that metal is very useful to convert back into currency to retire that dollar denominated debt and own those assets, those income producing assets, that farmland, that apartment building, that mobile home park, whatever it is, free and clear. So you have to understand how all these things fit together. And I think, again, the reason we're doing this series is because so many people in the real estate space, they know how to use dollars, they know how to use debt, they know how to use real estate, but they don't know how to use money. They think money and currency are the same. And that's the missing component for real estate investors. When real estate investors add money to the component, now they can play the game at a much higher level. And I wish I would have understood this 20 years ago, because 2008 would have been very, very different for me had I known this then. But it was because of 2008 that I got the lesson. And the good news, which is, I think, for the world, bad news for those people who aren't watching this and don't understand what we're talking about, is that the conditions that caused 2008 to happen and be a great opportunity for people that were right-footed, the conditions are like 10 times worse right now, which means the opportunity is 10 times bigger if you're right-footed. If you're wrong-footed, not so much. And that's why we're doing this series. So that's cost of production. Anything else you want to add to that part of the commentary there, Dana, before we wrap this module?
Well, when we're in parity with supply and demand, which is the primary driver of market price, and we get out of parity where there's more demand than supply, what people have to remember is they can't instantly just put a whole lot of new gold and silver onto the marketplace. New supplies don't come out and just appear like you go down and cut some more trees if you want some lumber. It doesn't happen. There's often a lag there between price rising, which creates more demand, a supply and demand imbalance, and then supply coming back in to fill demand. That takes a long time, which is why when silver makes a run higher, it can make a run higher a lot faster than gold, because it's a lot harder to replicate.
Well, then it's a tinier market. It's really tiny. Once money figures silver out and comes in, it's like trading in little penny stocks. I mean, it just takes off.
Right. That's exactly right. And that's another component that is very important. You're right. It's a much smaller market overall. So when the big money, and there's so much money in the world today, when that money decides it wants to play in this
Currency.
box,
There's so much currency.
pardon
So
me.
much currency going to chase the money. When currency decides it wants to get out of currency and get into real money, silver is going to be one of those destinations. And if you're a big money player and you're saying, okay, I can buy gold near its all-time high, or I can buy silver 2/3 below its all-time high. And I can, and there's all these upward pressure. I mean, we're not the only people on the planet that have figured this out, right? There's people that are beginning to figure it out.
Right. And that's exactly what's happening. Big money's been in gold and now it's, doing fairly well, but they're going to look for other places to go. And silver is naturally the next place to go. And it's starting to happen already. So good point.
And you just don't throw silver production online right away. I mean, these companies, when silver was down at the $11 range, companies literally, they ceased investments in exploration. They ceased, they just completely sat on these deposits that were too hard and too expensive to get to. Now, I'm not a mining stock expert, and I don't think you are either, so I won't get into that. Our good friend Brian London knows a lot more about that than we do. But if you're really fascinated with this whole subject, you ought to come to the New Orleans Investment Conference, which Dana has been a fixture. That's where we met. And our good friend Brian London, our mutual friend Brian London, puts that conference on every year. Hopefully he'll be able to do it in 2020 with this crazy COVID-19 thing, not letting anybody get together. But, if you're interested in learning how to play the security side of it, the stock, by investing in companies that have these deposits and can take advantage of these rising prices, I'm not here to talk about that. It's not my game. But there is a lot of money to be made if you've got some risk capital, high risk capital in your portfolio you'd like to kind of gamble with a little bit. But precious metals, I don't consider that to be really a gamble. It's like, to me, it's no different than saying putting money in the bank is a gamble. In fact, I'd make the argument putting money in the bank is a bigger gamble because of counterparty risk and because of almost near certainty that the dollar's future is going to be weaker than it is today. And when you're not getting any interest on your savings, like Kiyosaki says, savers are losers, right? You don't win by saving currency, but you do win when you save money, and there's a big difference. All right, so that's the cost of production as far as silver goes. When we come back, we're going to talk about the above ground stock and the differences between gold and silver and what that means to the future of silver. So stick with us. Hey, thanks for watching our silver investing series videos. We hope you're getting a lot out of them. Before you go, 3 things. Number 1, subscribe. When you subscribe, you build up our subscription base, and that helps us reach more people. But even more important, it helps us attract great guests and subject matter experts to share their ideas and information with you. Number 2, click that notification bell to make sure that when we do post a new video on this hot topic, you're notified right away. And number 3, share. Please share this information with friends. Help them get on board this bus. Help them protect and preserve their wealth to take advantage of what's going on in the world today. All right. Thanks so much, and we'll see you in the next video.